What's going on, everyone? Sid Misra here, certified financial planner. Thank you so much for tuning into my channel. I'm back with another episode of Ask a Financial Advisor, where I answer the questions sent in by you, the viewers of my YouTube channel, the listeners of my podcast, my connections on LinkedIn, and everybody else that consumes my content. Now, this question comes to us from a LinkedIn connection who sent me a direct message. And their question is this: I keep hearing about all the benefits of retirement accounts like IRAs and 401ks, both traditional and Roth. My question is this: should I be taking advantage of taxable investment accounts? Fantastic question, and one that highlights the importance of financial planning, where we look at all the different types of accounts that you can be investing in. And that's called asset location. Which accounts are you using to invest in, and what are the tax advantages that each account has? And the reason that we do this is so that we can try to be as tax efficient as possible, to take advantage of not only the tax advantages and tax breaks now, but also those things during our lives and in the future. How can we pay as little in taxes as possible? So tax planning and asset location are very, very important. And that's why this is a great question. Let's get into it. So for taxable accounts, there are several advantages to using these types of accounts for your investments. Number one is that there are no contribution limits for these types of accounts. Unlike an IRA or 401k, for example, taxable accounts can take as much money as you have. $50,000, $500,000, $5 million, for example. Your IRA or 401k have contribution limits that, yes, they do increase every year, but are certainly not as high as you would see in a taxable account. Taxable account has no contribution limits. Taking advantage of taxable accounts allows you to put more money away and have more money work for you. And who doesn't want that? The second advantage to taxable accounts is the access to funds. You see, in a retirement account, you're not supposed to touch the money until you retire. At the earliest, age 59 and a half. And if you take money out before that time, you'll be assessed with a 10% penalty. A taxable investment account has no such rules, and so it allows you to access your money a lot earlier than age 59 and a half and without a penalty. And this is great if you have an emergency or you're trying to save and invest for both short and intermediate term goals. The third advantage of taxable accounts is the tax optimization. Now, everyone's probably thinking, well, IRAs are supposed to be the most tax optimized accounts, but that's not necessarily true. In an IRA, a regular one, when you get to a certain age and you start taking your money out, all of that money, all of the money that you put in plus the gains is going to be 100% taxable, and it's going to be taxable at ordinary income rates, which can be as high as 37%. And in traditional retirement accounts, when you reach a certain age, you're forced to take out a distribution, even if you don't want to, because the government wants to be able to tax you on those distributions. So you're forced to take money out so that you can be taxed on it. Again, at a rate as high as 37%. So the advantage of having a taxable account means you have greater flexibility in how you manage your taxes down the line. There's no forced distributions at any specific age. And if you hold your investments for longer than a year, you're not going to be taxed at ordinary income rates. You're going to be taxed at the more favorable capital gains rates. Definitely an advantage versus a traditional retirement account like an IRA or 401k. And when we talk about optimization, there's also the little known feature of tax loss harvesting, which can only be done in taxable accounts. Selling out of a position at a loss and using that loss to offset any capital gains that you may have or lower your taxable income. That is an advantage that you can only get within a taxable account. And the last advantage is the benefit to your beneficiaries and heirs, the people that are going to inherit these accounts. If you inherit a traditional IRA, for example, or 401k, you're going to be forced to take out all of that money within 10 years. And that is not going to be beneficial to you tax-wise. That's going to add to your ordinary income and may push you into a higher tax bracket, costing you even more money. When your beneficiaries inherit a taxable account, there's no such forced distribution within a time frame. Your beneficiaries actually get a huge benefit by inheriting that account. They get what's called a stepped up cost basis on the assets, meaning they won't have to pay taxes on the gains that you accumulated. They will only have to pay taxes on the gains that they accumulated from that point going forward. A huge tax benefit to anybody that inherits a taxable account, and a benefit that's not available in retirement accounts. Now, I want to make this point clear. Utilizing a pre-tax versus Roth versus taxable account doesn't mean that you only get to choose one. You can have a combination of all three, and a good financial plan is most likely going to incorporate all three because of their different tax advantages. We want to be able to take advantage of all of them. Again, a good financial plan is going to diversify your tax liability and help you become more tax efficient over your lifetime. So if you have questions on taxable accounts versus pre-tax versus Roth, if you have questions on the tax benefits that you can get from tax loss harvesting or the stepped-up basis if you inherited a taxable account, I would recommend reaching out to a trusted professional, someone that can sit down with you and talk about your specific situation one-on-one. Your context matters, and you should be getting the one-on-one help that you deserve. Thank you so much for tuning in, and take care. I'll see you soon.